Okay, let's begin Chapter 5. In Chapter 5, we're going to be talking about fraud, internal control, and cash. Generally, or often, when we think about fraud, we think about theft of cash, but fraud can also include theft of inventory, theft of services, and other things. Fraud, as the definition here says, is a dishonest act by an employee that results in personal benefit to the employee at a cost to the employer. There are generally three things that contribute to fraudulent activity happening. That's opportunity, financial pressure, and rationalization. If you remember, we talked about the Sarbanes-Oxley Act in, I believe it was Chapter 1 or 2, and we learned that this act was put into effect to help prevent some of the things that had happened in the early 2000s when a number of companies were caught doing fraudulent things. There were a bunch of scandals back then that caused the United States to put some additional regulations in place so that this did not happen again. And this mainly involved internal controls within companies. Now, SOX applies specifically to publicly traded companies, but should be used by any company where possible. SOX also demands that this comes from the top down so that everybody is involved in making sure the company is in fact running properly. Internal controls should be developed so that the assets are protected, so that the accounting records are accurate, so that the operations is efficient, and that we're compliant with all the laws and regulations. And we hear a lot today about all the regulations surrounding companies. Some good, some bad, some an overstep, some necessary, but companies must be in compliance with those laws. With internal controls, we need to look at a number of different things. We need to look at the environment. We need to determine if there truly is a risk and where those risks are. We need to be able to control the activities, talk about what we're doing, communicate, and monitor. If we don't monitor, what's the point? The control environment really means that from the top, we have an environment that says we will not tolerate unethical and illegal practices in this company, from the top down. Managing our risk really requires that we determine where those risks are, and they're different depending on the size and the type of company that you have. Controlling activities means defining the policies and procedures that will help prevent the opportunity for fraud. Communicating our activities to all the employees, to everyone, is extremely important so that everyone understands what it is we're doing and why. And by monitoring, we're going to go back and look to see, are we successful in what we're doing? One of the principal methods of controlling is establishing who's responsible for what. If only one person is responsible for a task, you have a better opportunity to identify who is doing something wrong and what it is they're doing. This is often done also by segregating duties. One person is not responsible for an entire process. If someone is receiving cash, someone else records the cash and someone else takes the cash to the bank. Segregation of duties. How we document our transactions is another method of internal control. In prior chapters, when we were learning how we recorded transactions, we just were given numbers and amounts and said, we were told, well, we received cash for this or we wrote a check for that. But actually in a company, every one of those transactions would include a document of some sort. If we're writing a check, we have obviously a check in our hand. If we're billing a customer, we would have an invoice in our hand. There's always a document that goes along with the transaction that we're recording. So documents should be pre-numbered, and you all know if you have a checking account, your checks are numbered. But the important part is making sure we account for all of those numbered documents, that we don't have any missing numbers. With computerized software, that's fairly easy to do. You still have to check and make sure everything's there. And if you're using a manual bookkeeping system, then you need to determine a way that you can make sure every numbered document is accounted for. There's also other types of controls that we can handle. There can be physical controls. Physical controls, those wonderful monitoring systems that are so invasive of our privacy, but they do allow us to see what's going on. How many buildings do you go in now where they're being monitored by cameras and other methods of seeing what is going on? There's also safes, time clocks, locked warehouses, alarms, all sorts of physical controls that help us to safeguard the assets and safeguard the company from potential fraud. You may ask, how does a time clock count as a physical control to safeguard the company? Well, if you have to actually clock in and out, it's a little harder to, add an extra hour onto your time, or that extra 15 minutes that can build up over a period of time if you're handwriting your time sheets. I like this, computer facilities with passkey access or fingerprint or eyeball scans. I think that's actually called iris scans, but that's just me. We also have internal verification. Now, when we think of audits, we generally think of an accounting firm, a CPA, coming in from the outside and doing an audit. But internal audits should be done often, and your larger companies actually have a department of internal auditors. These employees are often separated from the main body of employees, and they conduct audits continually much like the annual audit conducted by an outside CPA. With an internal audit, someone is checking over the work to make sure things are correct. They're reviewing what other people do. We can also do some other things with our employees that help with the internal control. We can bond employees. Bonding is an insurance against theft. With bonding, most insurance companies will run a background check to make sure the person is actually able to do the job and that it's not a risky hire. We also rotate duties and require vacations. Do you know that little person that never takes the vacation and nobody ever really does their job? In fact, nobody really knows what it is they do. That's the one you want to watch. And conduct thorough background checks. And that involves more than just calling their references. There's a number of ways to do background checks. In human resource, if you take human resources, they go really more in depth into what you can and cannot do when hiring employees. Now this is important. When we talk about all of these internal controls that we should have in place, there is a lot of cost involved with that. It is not cheap to be able to segregate duties. It is certainly not inexpensive to put a monitoring system into a company. All of these things cost money. And many small companies simply don't have the number of employees to do what it is we've just talked about. So the cost should never exceed the benefit. Is it worth having 4 employees that you're having to pay simply to make sure that the money gets to the bank in the right manner? In a company my size, no, I can't afford that. I would be out of business in 6 months. So the cost cannot exceed the benefit. There's always the human element that we must think about. We're people, and we sometimes make mistakes. We're sometimes inefficient. We're sometimes lazy. So you have to take into account the human element. What is happening with this person? Sometimes you even have to talk about or think about perhaps 2 or more people that are getting together to circumvent the controls that are in place. And as I've mentioned before, the size of the business will limit internal control. The smaller the business, the more the owners and the management need to be very, very involved in internal control, because you don't have the size of a company that allows you to have either internal audits or the number of people that would be required to segregate all the duties. Now let's talk about some controls when we're looking at cash. First, we'll talk about cash receipt controls, and then we'll move into other areas of cash. Now, we've already talked about some of this. We bond our employees who handle cash. We have physical controls where our cash is in safes and banks. And you know, it's interesting. At church, I am the treasurer of our church. Physical controls on the cash that the church collects. On Sundays, when the offering is taken, after church, the ushers immediately take the cash. 2 ushers take the cash, take it to the office, put it in a bank bag, and the 2 ushers walk the cash across the street to the bank and place it in the night deposit box. So even in a place as small as our church, we have internal controls, physical controls, where the cash is handled by 2 people and placed in a bank so that access to that cash is limited. In many businesses, you're receiving cash over the counter. That just simply means that there is a cash register, someone scans or keys in the purchase, and the customer hands you check, cash, credit, debit cards. So you have a sales clerk who enters that cash. The sales clerk then sends that, takes her drawer out at the end of the shift, counts it, and sends it to someone else. In this case, they're calling it a cashier. The cashier or clerk in the office counts the cash again and prepares the deposit slip. And probably either takes it to the bank or has someone else take it to the bank. A different person takes the cash register tape and sends that tape to the accounting department. The accounting department then makes sure that the tape agrees to the deposit ticket. Well, that's a lot of steps, and those steps may not necessarily go in that order or with those particular people, but companies develop steps so that the cash receipts are not all handled by one person. Even in my office, as small as we are, the front office collects all the payments from our tax clients. They record those payments on a spreadsheet, and then Joshua, one of the partners in the business, takes that spreadsheet, compares it to the cash in our cash box, compares that to the clients we have served that particular time period to make sure we're not missing or no one's left without paying or someone's paid and the cash went in someone's pocket. So we have internal controls. As small as we are, you do what you can so that the controls are in place, particularly for cash. Mail receipt should be opened by 2 people. Some of this is a little, I think, redundant. Generally speaking, when you receive payments in the mail, it's a check. And yes, as soon as they're opened, the check should be endorsed with the bank stamp that says for deposit only. It's very difficult to be fraudulent with checks. Banks will not cash a check made payable to a company, particularly if some employee just walks in and says, "Hey, I want to cash this check." It's a little more difficult to be fraudulent with checks that are received, whether in the mail or via the cash register. Cash receipts. It's very important that we're very careful with the cash coming in. It's also very important that we're very careful with the cash going out. We should always, in a business, pay by check or electronic funds transfer or debit cards, something of that nature. Paying with cash should not happen except very, very small amounts, paying the paper boy. something of that nature. There are controls that we need to have in place for our cash disbursements, just like our cash receipts. We've talked earlier about using pre-numbered documents for all of our transactions, and that applies to this when we're using checks, and we must account for them. Even in a software accounting system, there is a means of checking for missing numbers. Establish responsibility. We've talked about that. Who is authorized to sign the checks? Do you need 1 or 2 signatures on each check? Segregate the duties so that different people are placing the order, approving the payments, signing the checks, so that everything is checked and rechecked, so that we're not dispersing money and not knowing where it's going. Again, we have independent internal verification. That can be as high up as internal audits or simply doing bank reconciliations. We're comparing the checks that have cleared the bank to what we said we have written, and we're looking to make sure those checks were actually written to the company that they were supposed to be written to. We're still bonding our personnel, and we're storing our blank checks in a place that they can't just be taken. At my office, we handle bookkeeping for a number of companies. And for those companies, we write their accounts payable checks. Now, that would be a lot of documents I would need to have secure storage for. I would have checks on hands for a number of different companies. What we have done to handle this physical control is we use blank check stock. So that if you steal some of our check stock, it's just a blank piece of paper. We have a Micker printer, that's the magnetic line that is on the bottom of checks so that the bank machines can read the checks. And we have software that allows us to print the necessary information, company name, the routing number, so that when this blank piece of paper comes out of our printer, it's a check ready to go to whomever, whatever vendor that we're paying. So our physical control is not keeping any check stock on hand, just the blank paper. So you can find ways to handle internal controls that may be slightly different than what we're talking about here, but that still takes care of protecting the assets of a company. Many companies use a voucher system so that not one single person has control of approving a bill, writing a check, signing a check, and sending it out. A voucher system is a network of approvals. Someone fills out the voucher in the beginning saying, this bill needs paid, and then it goes to the next person, probably the accounts payable clerk, who files it until the date it needs to be paid. Then a check is issued, which is then sent to the person who can sign the check and determine that the check and the voucher and the invoice are all correct. And from there, the check is sent. It's recorded in the accounting system. And then the next step would be doing a bank reconciliation to prove that it actually went to the right place. There is in the book, and I'm sorry, I'm not sure what page it's on now. They were talking about one of the ways fraud is perpetuated by an employee would be by taking the check and whiting out the name of the vendor and writing in a different name. I can tell you that doesn't happen. No bank would ever cash a check that's been whited out and something else written in. That just isn't a way. But it is possible to create vendors that are not real and then open checking accounts in that vendor's name and have the check sent to yourself. So there are ways to perpetuate fraud with disbursement, which is why the voucher system and having more than one person look at the information before a check is actually sent is important. Electronic funds transfer. We all do it. And don't call it EFTs. Our debit card, that's an EFT. It's an electronic fund transfer from our bank account to the company we're purchasing something from. You can also do that as it's called a wire transfer. Your company does that when they direct deposit your paycheck. It's a wire transfer. They're not using a debit card, but they're using a computer to transfer cash from one place to another. Really good internal control because there's not a check or cash that anybody handles. But it's also easy to be fraudulent because someone is keying in that information. So there's always the potential for fraud even with electronic funds transfer. Bank statements. How many of you have bank accounts? I would guess everybody that I'm speaking to. Do you receive bank statements in the mail? Or do you have yours sent to you via email? And do you even look at them? Or do you log on to your bank and look at the statements there? How many of you reconcile your bank account? I wish I could see the hands that are not raised. It's very rare in today's world that anybody actually sits down and reconciles a bank account. We have online banking. We just simply look up to see how much money we have or don't have, whichever the case may be. But companies still receive bank statements, even if they go online and print them out. They still receive their bank statements, and they must reconcile their checking account. What does that mean? Well, that means reviewing and making sure what's on the bank statement matches what's in your accounting records. So each month we get this statement from the bank. It shows us everything that has happened, all the transactions, all the checks that have cleared the bank, all the deposits that were made, any electronic funds transfer, incoming or outgoing, that have happened. Everything is here. Now on the bank statement you will see it says deposits and credits. So money coming into our bank is considered a credit. Checks and other debits, anything going out of the bank account, whether via a check or a debit card or some other form of EFT, is a debit. So if everything's correct in our books and on the bank statement, that balance on the statement should match our accounting records, right? No, it will never, or if it does, it would be very unusual. And why is that? Because of timing issues. If I wrote a check on the last day of the month, chances are it hasn't cleared the bank by the time the bank statement comes out. If I make a deposit, let's say late in the day on the last day of the month, the bank may not actually record that deposit until the next day. So we always need to check and verify and make adjustments when necessary so that we can prove the bank statement and our cash in our accounting records. That's called reconciliation. And as I've just said, the bank statement shows us everything that has gone out of our account and everything that has come in to our account. Sometimes you will see things that says debit memorandum or credit memo. Those may be transactions either coming in or going out that are a little bit different than a check or a deposit. It may be a service charge or a bounced check or interest that we've earned. So if we want to reconcile, we need to look for what's called deposits in transit, meaning the deposit is recorded on our books, but not yet recorded in the bank, or outstanding checks that we have written and sent to the vendor, or to our employees, or to someone else that have not yet cleared the bank. And then we also need to look for any banking errors. If we've made an error, if the bank's made an error, we need to look at those things. This is how we would reconcile our bank account. We would start with the ending balance on our bank statement, and we would add or subtract any items that are in our books that are not on the bank statement. So we would add to the balance on the bank statement any deposits in transit, and we would subtract any outstanding checks. And if there are any bank errors, that could be adding or subtracting to get to the correct balance. Then in a separate column, we take our cash balance per our books, and we add in or subtract from anything that is on the bank statement that is not yet in our books. Okay, now stop and think about that. On the bank statement side, we add and subtract items that are on our books but not on the bank statement. On our books side, we add and subtract items that are on the bank statement but not yet in our books. What we should receive or get when we've totaled both of those columns down is the same number in both columns. I'll give you a minute to stop and think about that. Okay, let's walk through a bank reconciliation. Bank statement shows a balance per bank, $15,907.45. The cash per books is $11,709.45. And then we have this list of items that we will use to do our reconciliation. We have deposits in transit. We have some outstanding checks. We must have found on the bank statement that we received money from a customer that we had not recorded that came in via an EFT. Had some credit card fees, service charges, an NSF check, and there was an error on a check that was written and cleared the bank. So let's move forward. Here we have our two items we're going to start with, our cash balance per the bank statement and the cash balance per the books. And we're going to add or subtract items that are in our books but not on the bank statement from the bank statement balance. We're going to add or subtract items that are on the bank statement but not yet recorded in our books from the cash balance per our books. So deposits in transit are in our books. We've recorded the deposit. It's just not yet showing on the bank statement. That's an addition. We will subtract the checks that have not yet cleared the bank. On the other side, we found the electronic funds transfer, the direct credit to our bank account that was not recorded in our books. That would be a deposit we had not yet recorded. So we'll add that to our balance per books. We found that we recorded a check incorrectly. We actually recorded it in our books for too much. So we need to add that back into our cash balance. There was an NSF check. A customer wrote us a check for payment, and we deposited that check, and that check bounced. They did not have the funds in their account for that check. Now, an NSF check, when we get it back, that customer owes us money. If the customer owes us money, what does this check need to become? Let's think about it. We'll talk about it more in a moment. We had debit and credit card fees we need to subtract, and we had our bank service charge. Now, we'll total both sections. So our adjusted cash balance per the bank is $12,204.85. And our adjusted cash balance per our book is the same number. We have reconciled our accounts. And that's nice. We've done a good job. But there's one more step. Of course, there's always one more step. Right now in our books, we're showing this cash balance of $11,709.45. But we've just determined that our cash balance per our books should be $12,204.85. So we need to make some entries so that our books are correct. Remember, we've talked about our books need to be accurate, timely, and usable. And right now our cash balance per our books is not accurate. Let me back up just a moment. The items that we need to use to make entries into our books are the items in the cash balance per books section. Remember, the items and adjustments we've made in the cash balance per bank statement are already in our books, so we don't need to do anything with these numbers here. We do need to do something with the numbers in this section. So, first, we collected money from an EFT. A customer paid us. If a customer paid us after the fact, after the work was done, what are they doing? What are they paying? Okay, you've thought about it now, so we're going to increase our cash because we received money, and we'll decrease our accounts receivable. The customer owed us money, so that becomes a receivable, and they've paid what they owe us, so we're reducing our accounts receivable. Obviously, our cash is going up, and we've not impacted anything on our income statement. Check number 443, which was recorded incorrectly in our books, was a payment on account to Andrea Company, a supplier. Payment on account. Have you caught that one yet? Yes, accounts payable. We were paying a vendor that we had purchased something from on account. So our cash will be increased because we entered the check incorrectly. We entered the check, let's see, the check was actually written for $1,226, but it was recorded as $1,262. So we entered the check for an amount that was higher than what it was actually written for. So we'll increase our cash and we'll increase our accounts payable because we had reduced both our cash and our AP by too much when we recorded the check incorrectly. Now, the NSF check. A customer paid us at the time the service was rendered, I'm assuming, and that check did not clear their bank when we deposited it. So now the customer owes us money. And if the customer owes us, it becomes an accounts receivable. We're reducing our cash and we're increasing our accounts receivable. Bank charges expense. Fees are charged for debit and credit card transactions, and banks usually charge additional fees for servicing the account. Now, if you go back and look at the amounts, we were billed or charged $120 for debit and credit card fees and $30 for bank service charges. So we're going to make one entry of $150 in fees. Now we'll reduce our cash, but this time bank service charges are an expense. So this time we will have an entry under our expenses. We're increasing our expenses, which is reducing our retained earnings. Now, with these adjustments, if we total our cash account, our cash balance is now $12,204.85, which is the same as our adjusted cash balance from our reconciliation. It is important to remember that we must do the adjustments after we do our bank reconciliation. How do we report cash? Where do we report cash? And why do we report cash? Cash is reported on our balance sheet. It's generally the very first item listed on our balance sheet under current assets. And current assets are listed in order of liquidity, and there's nothing more liquid than cash. That's cash, coins, checks, all of those things. It's also listed on our statement of cash flow, which shows all the sources and uses of cash during the period of time that we're looking at. So cash and cash equivalents. What's cash equivalents? Those are our short-term, highly liquid investments. They must be readily converted to cash. And they're not sensitive to changes in the market or interest rates or those sorts of things. Also, there is restricted cash. Restricted cash is there for a special purpose. Some companies are required to keep particular amounts on hand because of pending lawsuits, or required to keep set amounts on hand because of particular regulations. One example in the book is talking about landfill companies must keep cash on hand for covering closing areas of their landfill when the useful life is over. Restricted cash is not available for general use. So restricted cash is reported on the balance sheet as a separate line item from cash and cash equivalents. And you would see this as a listing: cash, cash equivalents, short-term investments, and restricted cash under your current assets on your balance sheet. As you can see from this, a cash has an operating cycle, whether it's merchandising or service. You receive cash, you buy inventory, you sell items, you bill customers, you receive cash. Cash is constantly flowing in and out of a business. We have to manage our cash, and managing the cash includes collecting our accounts receivable in a timely manner, because when I'm selling something on account, I'm not immediately receiving the monies, yet I must in turn pay the company bills, pay my employees, buy inventory if necessary. So I'm spending money, but to spend that money, I need to be receiving money also. Cash management also includes keeping inventory low. We don't need stock on hand. Yes, it's an asset, but we can't pay our bills with inventory. We want to pay our liabilities in a timely manner. We need to plan for capital investments. The equipment we have is not going to last forever. The building we have may need, major renovations. So we have to plan for capital investments. And we want to make sure our money is making money. If we have cash on hand, it should be invested, not left sitting idle. So to do that, we have to budget our cash. That means we look at our cash flows. We look at what we believe is coming in and the bills that we'll need to pay. We look at and plan for those capital investments that I spoke about, so we can plan for the flow of the business. And this is a cash budget. Every one of them looks different, but you've done a budget before, I'm sure, even if simply in your head. I know my paycheck is this much, and my rent is this, and my car payment is this, and my car insurance is this. That's exactly what this is. A company simply looking at the inflows and outflows and projecting what those will be. And with that, we are finished with Chapter 5. Thank you. And if you have questions, please post those on the discussion board.